Good day everyone, and welcome to another webinar by Devonshire Accountants. This one's on the Jobkeeper Payment update received from the ATO on 24th April 2020 on the alternative testing. My name is Rana and I'm the Managing Director here at Devonshire Accountants. I've been involved in this firm since 2009, and prior to this I had various accounting positions around the world, starting in Kenya, United Kingdom and eventually in Australia. My experiences range in a variety of fields, including public practice, corporate management, sports governing bodies, insurance, banking, international top retail brands, beverages, hospitality and many more industries. I've in addition co-authored over 40 publications in accounting in East Africa and the United Kingdom. Before we begin, a very big thank you to everyone who has subscribed to our channel and supported us on our YouTube journey. Please keep subscribing so we can update you on the latest government stimulus packages and on the upcoming 2020 tax season. Our earlier webinars on Jobkeeper Payment were released on 1st of April, 5th April and 17th April 2020. So please listen to those as well, because this webinar is purely on the alternative testing. And I will be just highlighting the changes which we were waiting from the ATO and received on the 24th of April 2020 on the alternative test. So a quick reminder that the basic test remains the same. So however, if an entity satisfies the basic test, it does not need to go on to the alternative testing as determined by the Commission of Taxation. So very clearly, if you do meet the basic test, then that's it. That's where you stop and proceed with the applications. And I'll be discussing the alternative tests in this seminar. So moving on, as per my previous webinar, the Commission of Taxation, Chris Jordan, has the discretion to consider businesses that do not meet the core requirements in terms of turnover. So what we knew is that the Commissioner has the discretion to set out alternative tests that would establish eligibility in specific circumstances. Now, since then, the Commission has released the details on the alternative tests. We have more details, and these were released on the 24th of April 2020. So moving on, there are now 7 alternative tests that have been designed for employers who do not meet the basic test, which, as I mentioned, remains the same as previously announced. The 7 tests are as follows. The first one is business commence, so for new startups. The second one is acquisition of business. Third one is the restructure of business. Fourth one is a substantial increase in turnover. Fifth is if you're affected by drought or natural disaster. The sixth one is irregular turnover. And seventh but not last is the sole trader, if you're sick, injured or away on leave. So we'll go through the 7 alternative tests, and I'll touch the basics, which will give you some more information. However, we are here to assist our clients to go through this process as smoothly as possible and to make sure that we give our best shot in getting you into one of the 7 alternative tests. So looking on to the first one, which is the business commence, so for new startups. The key here is the entity commenced business after the relevant comparison period. The business did not exist in that period. So basically the business didn't exist 12 months prior. Say you have turnover figures for April 2020, but you don't have a comparative turnover figure for April 2019 because the business did not exist at that time. So we now have 2 options available. The first one is that you need to average monthly turnover since started your business. For example, if you started business 6 months ago, you take the 6 months turnover, add it together and divide by 6, and then compare that with the April 2020 turnover. So if there's a fall in turnover of at least 30%, then you qualify. So quite a straightforward calculation there. The second one is that if you take the last 3 months turnover immediately before the test month. So these are for businesses who've started in the last 3 months. So therefore, the average turnover is taken for January, February, March, for example, and then compared to the April period, which is your test period. And again, if you're 30% or less, then you qualify for the Jobkeeper payment. And there are other businesses which have been there for less than 3 months. So for example, immediately before the test month, let's take in this case 1st of March 2020, then the turnover is divided by the number of days and multiplied by 29, so the days in February. Then this is compared to the test month. So again, it's quite a straightforward calculation there. We just need to do the maths correctly, and these are for completely new businesses. So we just take the turnover and divide it by the number of days they've been in business, and then multiply it by 29, let's say February 2019, and that will give us a turnover figure which is then compared to the test month. Again, the 30% fall still applies. So that was on the businesses commence and new startups. The second one is acquisition by businesses. So here the entity acquired or disposed of part of the business after the relevant comparison period. The business did not have the same business in that period, and it has now. So if you bought or acquired a new business, that would have definitely increased your sales turnover, so you would fail the test under the basic turnover testing. So here the ATO mentions that the comparison period becomes the first full month immediately after the acquisition. So therefore, if you acquired a business in November 2019, you will need to look at only December 2019, that is the full month immediately after the acquisition. Then you need to multiply that by 3 to get the turnover for the quarter, if comparing the test period on a quarterly basis. If comparing on a monthly basis, for example, April 2020 month, then just compare the December 2019 month, which was the full month after acquisition. So again, with those calculations, ATO has made it quite clear for those businesses who acquired a new business. So you can see a lot of businesses will be qualifying for this. Moving on to the third one is the restructure of a business. Here the ATO mentioned the entity undertook a restructure after the relevant comparison period. The business is not the same business in that period as it is now. So similar to the previous one, but here the business is completely different now. For example, you had a transport business and now you have a restaurant. So completely two different businesses, and we cannot compare apples to apples. So here the ATO mentions that the comparison period becomes the first full month immediately after the restructure. So the rules here are similar to point number 1. Therefore, if you restructured the business in November 2019, you will need to look at your December 2019 month. The fourth one is the substantial increase in turnover. And I feel, and speaking to other accountants earlier over the weekend, we think that this is going to be quite the key one. So under this, the ATO have come up with the following. So the entity's turnover substantially increased by 50% or more in the 12 months immediately before the applicable turnover test period, or 25% or more in the 6 months immediately before the applicable turnover test period, or 12.5% or more in the 3 months immediately before the applicable turnover test period. So in this case, you don't have to meet all the 3 requirements. You only have to pass 1. You just tick 1 to pass, and you pass the turnover test. So looking at the first one, the 12 months, if you can show your turnover increased by 50% in the last 12 months, say we take March 2020 as your test period, we go back and compare March 2019. Say the monthly turnover was, keeping the numbers quite easy, the turnover was $100,000 and is now increased to $150,000. That's a 50% increase, and you qualify under that straight away. ATO also understands that businesses were not around for 12 months, so the other 2 tests are for the 3 and 6 months. So new businesses under the 3 months, you will have to look at January, February, March. Then you compare your December 2019 sales to March 2020 sales, and if the December sales have increased by 12.5%, you qualify. The same applies to the 6 months. You need to show an increase of 25%. So in this case, September 2019 to March 2020, and if that's up by 25%, you pass. So it's quite simple, and I feel a lot of businesses might fall into this category. So looking at the test periods this is how we'll work them out. So let's explain a bit more on this one, because we feel that a lot of businesses will be falling into this category. So comparison period, let's say if it's for the 3 months prior to the test period, if the test period is a quarter. So I'll repeat that. Comparison period is the 3 months prior to the test period if the test period is a quarter. So if you're testing April 2020, you will need to take into account January, February, March and work out an average of the 3 months. Or the last 3 month average prior to the test month if the period is a month. So if your test month is March, then you take December, January and February to work out an average. So those I feel that in that category number 4, I think a lot of the tests, a lot of businesses would fall in, especially the new ones. So we do understand that these calculations can be a bit difficult at times, and clients are a bit confused. But please do not hesitate. We are here for you. We are here to help you. And this video is just to provide you information and not actually provide any calculation basis. So we are there to kind of assist you with all the expertise required in that. Moving on, the 5th one is affected by drought or natural disaster. So here the ATO mentions the entity was affected by drought or other declared natural disaster during the relevant comparison period. So this is quite a straightforward one, quite relevant to primary producers. So you look at your 12 months prior to your test period, and if it wasn't affected by drought and natural disaster, all you do is that you compare. Your comparison period then becomes a year ago, which in this case you could go into March 2018. So if you're testing for March 2020 and you go back to March 2019, but due to the effects of drought and you don't have those numbers, so you can go back to March 2018. So that's quite a straightforward one. Moving on is the 6th one, which is the irregular turnover. Here the entity has a large irregular variance in the turnover for the quarters ending in the 12 months before the applicable turnover test period, excluding entities that have a cyclical or regular seasonal variance in their turnover. So quite applicable to construction companies. They have big projects, and then obviously once the project is finished, so their turnover is quite irregular. So in this one, what happens is 50% difference between the top month period and your lower month period. So what needs to happen here is you look at your 12-month comparison, so March 2020 to March 2019, and you take the average, and that becomes the comparison. There will be up and downs, but however in this one you just look at the 12-month comparison, March 2020 to March 2019, and you take the average, and that becomes the comparison. The last one is this for sole traders, sick, injured, or away on leave. So here the ATO mentions the entity is a sole trader or small partnership where sickness, injury, or leave have impacted an individual's ability to work, which has affected turnover. So this will also include smaller partnerships. As you know, in Australia we have a lot of mom and dad partnerships, so it will consider they can come into this category. So under this one, your comparison period becomes the first full month immediately you return back to work. So for example, if you're doing the March period tests, then you go back to March 2019, and if you are sick or injured or on leave, say for 4 months, and return back in August 2019, then August 2019 will become your comparison month, or September 2019, which might be your full month. So you will then compare that to your March 2020 period. So those were the 7 alternative tests. I know we have gone through them quite quickly. However, our team is here to help you all and provide you more information on the 7 tests. But this was just to give you a bit of a highlight of what's happening. Now the calculations are different for all the 7 tests, so we will need to determine which one you fall in, and how we will, moving forward, do the calculations. Just moving on, very importantly, now there are 2 key points which I wanted to mention again. Now, the employer registration date has now been extended to 31st May 2020 from the initial 30th April 2020. So the ATO mentioned that on the 24th of April, that date has been extended to 31st May, so to allow more businesses to apply for it. So that is good news. But however, we are moving across a lot of applications and putting them in before 30th. But there is a bit of a more flexible timing. Secondly, also ATO has mentioned that the turnover method can now be either cash or accrual basis. So listening to our previous webinars, we did mention that if you're reporting on cash basis for your GST, then you need to report on the cash method for your turnover testing. However, you can now use either method for the turnover test. So that's another change there. So those are two changes, the date and the methods as well. I hope this has been a useful webinar. Myself and my team at Devonshire Accountants are available to assist you, so please do not hesitate to contact us. Lastly, please subscribe to our YouTube channel and don't forget to click the bell for future notifications. Our contact details are on screen as well, and we are here to assist you in the best possible way. Please also follow us on Facebook, Instagram, LinkedIn, Twitter, and obviously YouTube. Thank you once again. Stay safe. Work from home where possible, follow social distancing rules, look after yourself, your family, and people around you. Thank you.